In this video, I'm going to talk about a small business tax strategy that you can use if you're suffering from this pandemic, you're tight on cash, or just about to be tight on cash. Now, this strategy is on the horizon. I've been looking at everything that the government has been issuing as far as tax relief and other forms of relief. Now, this is on the horizon, and you want to be aware of it now, because if you get ready for this action, you might be able to reduce your taxes and free up cash flow immediately. Now, before we go through this, if this is your first time at our channel or you haven't subscribed, click on the subscribe button at the bottom. My name is Travis Sickle, Certified Financial Planner, helping you reach your financial goals. So I want to get right into this. With the government issuing all this different relief packages from the state level, from the national level, you want to look through all the different opportunities or the things that you have available to you to keep your business afloat and moving forward. And I want to start with the proposal for the CARES Act. Now, the CARES Act is the Coronavirus Aid, Relief, and Economic Securities Act, or the CARES Act. And this is outlining relief for small businesses and including individuals. Now, if you look at the small business side, most of this stuff, the relief package, is in the form of loans. Now, it might be really difficult to consider a loan. If you need one or you're going to take one and it works for you, that's great. But for a lot of people, there is a massive amount of uncertainty of whether or not their doors will ever open again, whether or not we can survive this. So it's really, really uncertain times. So a lot of this loan stuff might not be the relief that you necessarily are looking for or even want, but there is an opportunity if you look at the individual section. Now, this individual section could be used for your small business. And here's what I want you to take a look at. Look at section 2103, which is special rules for use of retirement funds. Now, I'm not advocating to use retirement funds. I want to say that right off the bat, but there is a strategy that might work for you. So here's what it is. Now, what it's outlining is your ability to tap your retirement accounts of up to $100,000. Now, that sounds like a terrible idea because for the most part, you're probably invested in the market, which has gone down quite a bit. So just adding fuel to the fire, not really solving the problem, not really offering much relief. And even if you did sell out of it, you're still locking in those losses. So really not the best of moves. So here's the strategy. If you have cash or you don't have cash, I'm going to give you ways to handle it in both scenarios. But if you have cash on hand and you make these additional contributions to these retirement plans for 2019, you're going to reduce your taxable income. So either you're going to reduce your overall tax liability or get a bigger refund. Immediately puts money back in your pocket. So let's run that scenario really quickly. Let's say that you take $6,000, you put it into just a traditional IRA. Let's just start there. A traditional IRA, you're in the 22% tax bracket. So that's 6,000 times 0.22, which is $1,320. So you're going to have $1,320 that you just put back in your pocket. Married filing jointly, same thing. That's going to double the amount. And if you're 50 or older, you can do an additional $1,000, bringing the total contribution to $7,000 a piece. Now let's look at the other side with the SEP IRA or the 401ks. If you can make a profit sharing contribution to the 401k, or looking at the SEP or even the solo 401k, just making the similar contribution. Let's say that you put in $20,000 into that plan, you're in the 22% tax bracket. It's going to be $4,400 in additional taxes that you've just saved. Now, the money's not immediately locked up because remember what we just talked about, that section 2103, we can access those dollars. So we can pull that money right out and still have it in the bank, but we're reducing our tax liability. Now, going on down the road, you have to put this money back within 3 years, and none of this has been put into force just yet. So you want to watch very closely because there's going to be a timing issue here. Because making the contributions into a traditional IRA, it's not clear whether or not that was extended. So both filing and paying were extended to July 15th, but making that traditional IRA contribution, it's not a done deal just yet. So we haven't seen any guidance on whether or not you can make that after April 15th. But if you can't, and this legislation goes through, at least you know what you're dealing with. So you can make the decision of whether or not you want to make those contributions, reduce your tax liability, and then take the money right out so it's right back in your bank account. Just understand that over 3 years, you're going to have to put that money back into your retirement accounts, but at least it's reduced your total tax liability. And really, you have to think about whether or not your tax liability will even be as high as it was in 2019, in 2020 versus 2021. Now, I mentioned that if you don't have any cash on hand and you were making contributions into a Roth IRA, you could still take that money out of the Roth IRA if you've made those contributions for 2019 and flip it right over to the traditional IRA. And that is not a recharacterization. That is just taking money from the Roth going to the traditional. It's a completely different strategy. It's not a recharacterization, so you can do it. And if you have no cash or very little cash on hand and you haven't made any of these contributions to make any of these adjustments, there is one last opportunity if you have a Roth IRA. Maybe you made it in years past, the contributions. You can pull the money or the contributions out of the Roth IRA to make the contributions that I just mentioned. So you can put it into the traditional side, or you can put it into a SEP. So if you have a ton of money in the Roth IRA and you're going to go over that $6,000 limit for the traditional side, then you can look to the SEP IRA to see if that works in your particular situation. So there's a lot of flexibility here and possibly a strategy that you can reduce your overall taxes, free up some of that taxes today and push it forward, which you might be in a lower tax bracket moving forward. And let's not forget the tax credits that you might qualify for just by reducing your 2019 taxable income. So if you're on the healthcare.gov Obamacare healthcare plans and you're getting a premium tax credit, then this might qualify you for additional credit. It means a bigger refund, especially if you're already paying into it. Or you can look at the savers credit, lifetime learning credit, or if you're on the higher income side, then you can look at the child tax credit. All these different credits that you might have phased out for previously might be actually available because you can make the contribution, but still get it right out of there. So this isn't necessarily locking your money up. So if you do have that cash on hand and you make the contribution, you'll have the opportunity to pull it out. The only catch is over the next 3 years, according to this, you'd have to put it back. Now remember, this isn't in effect just yet. So you want to keep a close tab on it because the changes happen really, really fast. And until it's signed into law, it doesn't exist. So keep a close tab on it and hopefully it comes out where you can use this strategy and hopefully it will benefit you. If you've enjoyed this video, be sure to subscribe and leave your comments down at the bottom.